Hi everyone, Darren Green from Mila Homes here, and welcome to day 3 of 12 of the 12 days of property investing. So today we're going to get into the power of leverage. So we're going to cover a couple of things today. We're going to go through what is financial leverage, and we're going to cover off how you can use leverage in property. So what is leverage? Well, simply put, leverage is the investment strategy of using borrowed money. So specifically using borrowed capital by the way of debt to increase the potential return of an investment. So things that count as leverage are mortgages. So in the property investment world, myself and Jill, we'll use buy-to-let mortgages where we own 25% of a property, the bank owns 75%, and that allows us to own many more properties, I guess, than if we had to own the property outright. Okay, so mortgages allow us to are a tool that you can leverage. Now, when we talk about companies or people being over leveraged, what we mean is that the level of debt that they have relative to the equity within the value of the asset is relatively high. So for example, in that scenario there that I just gave, where we own 25% of the property and the bank own 3/4 of it, or 75%, you could say that is highly leveraged. The bank is highly leveraged there. So I'm depending on the majority of that value of that asset from the bank. So word of warning from the past, and I'm calling out there that over leveraging beyond appropriate level of control is not advised. So what if you can cast your mind back to 2008, banks were effectively giving you 100% mortgages, and we're seeing recently, we started investing a few years ago, and it was you could only get a buy-to-let mortgage on 75%. Now what's happened in the market recently is that started to creep up. So you can now get, I think, 85% loan to value mortgages. But back in 2008, if you remember, banks were actually offering 100% mortgages. So if I had a property worth £100,000, then the bank said, here you go, Mr. Investor, here's £100,000 worth of debt that you can invest to buy that property. And what happened was the price, the financial markets crashed, property prices crashed, and banks started calling in their loans. And what happened was a whole load of people that had a property, they'd bought it for 100,000, it was now worth maybe 80,000, and the bank wanted 100,000. That was the loan. So a lot of people ended up losing their houses, going bankrupt, because not a lot of people have that sum of money just sitting around ready to give back to the bank. So it's quite serious stuff. And when that started happening, banks were effectively saying you've got a couple of months to find, say £20,000 in that example. So definitely something that we need to be wary of. That's why I guess myself and Jill have taken a tack that even though we could start to get 85% loan to value mortgages, we finance everything at 75%. In the last 60 years since Axel Records began, any property price crash has never been deeper than 20%. So if we've got comfort that we own 25% of our property portfolio, we feel that that's a reasonable level. We will look to bring that down over time, but we're comfortable where we are just now, that we would never go in excess of leveraging more than 75% of that asset. Okay. So I've touched on some of this already, but how can I use leverage in property? I'm going to run through an example here where you have investment capital of £100,000. Now what you can do with that, very simply, option one, you can go and buy a house outright for £100,000. Very straightforward. Option 2, you can actually buy 4 houses using 75% loan to value mortgages, very similar to what myself and Jill do right now. Okay, so you can see how that works. You get by 4 times the number of houses, which depending on what you do with them, you can turn them into assets. So how have house prices performed? So those of you who might follow me on Facebook or social media might have seen the chart on the left before. This is the Nationwide House Price Index. Effectively tracks property prices in the UK and goes back to 1952. So the information on the right hand side is probably more of a surprise to you, and this is the time taken for house prices to double since 1952. So on average, house prices double every 9 years over that period of time. The fastest period that house prices have doubled is 3 years, and the slowest is 16 years. Now that 16 years is actually a new record, and that's where we are just now. So the house prices at levels of 2002 are still not double. They're about £15,000–20,000 away from being double the value of what they were back in 2002. And as I said, I think that drop, that big blip that you can see there on the screen, is around 2008, where we've seen about a 20%, 19–20% drop in prices. So hence the reason why myself and Jill pitch our mortgage products at 75% loan to value. So what would these options look like in 20 years time if we put them against each other? So the reason I've chosen 20 years time is, as we just said, we're in this kind of slowest ever period of time taken for prices to double in value. So I'm being really conservative here and saying, look, if you bought something right now, in 20 years time, it's definitely going to have doubled in value based upon the data that's available to us just now. So option 1, really easy. You bought it for 100,000, it's now worth 200,000. You've got no mortgage costs at all, so it's worth £200,000. Option 2, we spread it across 4 properties. We put 25k in each. Now that property value, each one is worth 200,000, so we have 125,000 equity across each of them. However, at this point I want to include the mortgage costs. So over that period of time, we've had to incur about 90,000 per property of mortgage costs over 20 years, which seems a lot of money. And that's based upon a 6% interest rate. Right now, most of our interest rates are below 3%. So, but on average, kind of between 5 and 6% over a 20-year period feels pragmatic. So, after all of that's included, the investment return, once you include all of that for option 2, is only 140,000, so 60k less. So how does this look in 20 years time when you bring into account rental income? So option 1, we had 1 property. We now have a value of £200,000, which we can add to that £120,000 we think we will make on that over a 20-year period, based upon having £500 per calendar month. Okay, that brings the total investment return for option 1 to 320,000. Now let's have a look at option 2, and this is where the magic happens. And this is where you start to see the real power of financial leverage. So we had 4 properties, which means that 120,000 return, we've got that 4 times. You add that to the 140,000 that we showed on the previous slide, where we had deducted the mortgage costs, and all of that together gives us 620,000, which is almost double what we have coming out of option 1. So hopefully you can see that it's quite a simple scenario, but what I'm looking to share with you there is really the power of financial leverage. When it's used sensibly, when it's used correct, in the right way, over the long term, financial leverage can be absolutely beautiful. So it's certainly something which myself and Jill try to do with our portfolio, without going to the extent of over leveraging, but leverage in general, debt over a period of time because of inflation will always pay itself off over time. So these are all interest only mortgages that we're talking about here. So people sometimes get a bit worried about that and funny about interest only mortgages, but if you think even at the moment inflation's 3%, if I have £75,000 worth of debt across each of these properties in this example, that 75,000 of debt is eroding relative to existing money by 3% every single year. Okay, so in 20 years time, not only is the value of the property going to be double in value, or highly likely to be double in value, the relative debt that you'll have on from that 75,000, yes, you'll need to pay £75,000, but world costs have came up to a level now that 75,000 isn't quite cheap change, but it's certainly not as valuable as the 75,000 that you borrowed 20 years ago. Okay, so I hope that's been useful and you've got some value out of it. So as always, if you'd like to get in touch and understand a bit more, obviously our contact details are there, so please get in touch. There's a disclaimer at the bottom, as I stated earlier in the presentation. If you are looking to invest in property, I'd always recommend you go and speak to actual professionals. So particularly when you're talking about financial products like mortgages, etc. So make sure you go and do that. Okay. Hopefully that you found that useful, and I will see you again tomorrow for the next video. All right, thanks.